So, picture this scenario. You log into your Shopify dashboard at the end of the month, and, there it is in that big, beautiful typography. You sold $10,000.
Best feeling in the world.
Right. You were feeling fantastic about your business. So you pour yourself a coffee, you open up a new tab for your business bank account, and you go looking for that deposit from Shopify.
And this is where the panic sets in.
Exactly. Because the deposit is for exactly like $9,200. Instantly, the good mood just evaporates.
It's just gone.
Completely gone. You're sitting there thinking, where on earth did that $800 go? So you start clicking around, opening multiple spreadsheets, trying to match up individual customer orders to this seemingly random deposit amount.
Which is a nightmare.
Oh, it is. Within 20 minutes, you were just completely overwhelmed by the data.
Yeah, I mean, it is a universally maddening experience for almost anyone running an e-commerce business.
It really is. Welcome to this deep dive, by the way.
Glad to be here.
Our entire mission today is to demystify why those two numbers, your dashboard sales and your bank deposits, never actually equal each other.
And they really never do.
Never. We are working through a highly detailed source guide published on August 8, 2026, titled Shopify Accounting: How Sales Land in Your Books.
It's a great read.
And let me tell you, this document is basically the ultimate map to finding that missing money. By the end of this deep dive, you will know exactly how to translate your e-commerce data into your accounting ledger without creating a massive, tangled mess.
Which is so easy to do.
So easy. Let's just unpack this because, as a business owner, seeing money just vanish feels like a system glitch.
Right. The instinct is always to assume something broke. But the reality is that this gap isn't a glitch at all.
It's not.
No, the entire architecture is functioning perfectly. The discrepancy exists because, well, your Shopify dashboard is measuring gross revenue from orders, while your bank account is receiving a net payout.
Okay, a net payout.
Yeah. A payout is simply whatever cash survives after a highly complex series of financial mechanisms basically take their cut or, delay the funds.
So before we can even talk about how to organize the accounting books, we really have to track the physical cash.
Exactly. Follow the money.
I used to imagine this like a bucket of water going through toll booths, like it splashes a little out at every stop.
That's a good way to look at it.
But reading through this guide, it actually feels much more like looking at a paycheck. You see your gross salary, but you never actually deposit that amount because, well, taxes and health insurance get skimmed off the top before the check is even cut.
Yeah, the paycheck analogy is definitely a much better way to visualize the mechanics here.
So what are the specific deductions shrinking a Shopify payout between the moment a customer clicks buy and the moment the cash settles in the bank?
Well, the very first mandatory deduction is card processing fees.
Right.
Every single sale processed through Shopify payments settles net of its card processing fee. The credit card networks take their percentage instantly, like before the money even starts moving toward your payout batch.
Got it.
And if you are using a third-party payment provider alongside Shopify payments, you are often hit with secondary transaction fees on top of that.
Yeah, and that part I think most business owners expect, right? Like Visa and MasterCard are always going to take their slice of the pie.
Of course.
But as we dig deeper into the source material, there is a mechanism that genuinely shocked me. It's the guide refers to as the refund trap.
Ah, yes.
Yeah.
The refund trap completely breaks people's intuition about how money moves.
It broke mine.
I believe it. Because when a merchant issues a refund, they generally assume the software simply hits undo, and reverses the original transaction seamlessly.
But it doesn't do that at all.
Not even close.
Like, if a customer returns a $100 jacket, I don't just lose the $100 sale. According to the guide, the refund is deducted from my next available payout batch, not the one the sale originally belonged to.
Right. It pulls from the future.
And worse, Shopify explicitly states that the original credit card transaction fee is not refunded to the merchant when a refund is issued.
Yeah, that's a tough pill to swallow.
Wait, so if I sell an item, the customer changes their mind, I give back the cash. I am still permanently out the $2 or $3 for the credit card fee.
That's exactly right.
Am I essentially paying a penalty for the privilege of processing a return?
That is the mechanical reality of the system, yeah. You absorb the cost of the transaction having occurred in the physical network.
That is wild.
It is. But the accounting nightmare here isn't just the lost fee.
It's not.
No, it's the timeline. Because that $100 refund is pulled from your next available payout, the original sale and its subsequent refund usually land in two entirely different bank deposits.
Oh, I see.
Yeah, so if the sale happens on the 28th of the month and the refund happens on the 2nd of the next month, those two events are sitting in completely different accounting periods.
Which completely skews your monthly profit and loss statement.
Exactly.
So we have card fees permanently reducing the cash and refunds dragging negative balances into future payouts. What about chargebacks?
So chargebacks function similarly to refunds, but with added penalties.
Because it's never easy.
Right. If a customer bypasses you and disputes a charge directly with their bank, that disputed amount is instantly pulled from your next payout.
Instantly.
Instantly.
Yeah.
And on top of that, a separate chargeback fee is deducted. Now, depending on your region, Shopify might refund that fee if you successfully win the dispute with the bank.
Okay, so there's a chance.
A chance, yeah.
Mhm.
But in the short term, that cash is just gone from your deposit.
But there are scenarios outlined here where the money hasn't been permanently taken by a fee or a refund, but you still can't touch it. I'm looking
Yeah.
at reserves and holds.
Yeah, this is where we move from permanent deductions to temporary blockades. A reserve is basically a risk assessment tool.
Like holding it hostage.
Sort of. The guide highlights an example from Shopify's documentation where they might place a flat $1,000 reserve on your account, or perhaps hold 10% of all your transactions for a rolling 120-day period.
But why would they do that? Just to mess with your cash flow?
No, it is entirely about collateral.
Collateral.
Yeah. If your business suddenly goes bankrupt or fails to deliver hundreds of orders, customers are going to initiate chargebacks.
Okay, makes sense.
And if your bank account is empty, Shopify is the one left holding the bag for all those refunds. So by holding 10% in reserve, they ensure there is a pool of your own money available to cover potential disasters.
Okay, I get it from their perspective.
Right. And if those disasters don't happen, the money is fully released to you after the 120 days.
But mechanically, for those 120 days, my daily bank deposit is light by 10%.
Yes, it is.
And it gets even more extreme with a full account hold. Like, if Shopify flags an account for compliance issues, they can freeze payouts entirely. Yet, in most of these compliance cases, customers can still browse the store and check out.
Yeah, and if you connect this to the bigger picture of your ledger, you start to see why simply looking at your bank account is dangerous.
Definitely.
During a reserve or a hold, your dashboard revenue is climbing, your inventory is leaving the warehouse, but your bank feed shows zero incoming cash.
That would terrify me.
Exactly. But you cannot just write that gap off as a mysterious loss or assume your business is failing. That missing money is a receivable.
Oh, receivable.
Yes, it is an asset owed to you, and your accounting software needs to mechanically track it as a pending asset, not an empty void.
Which brings us to a massive structural hurdle. We've identified the mechanisms taking or holding the money, but the silent complication running through all of this is time.
Time is the enemy of e-commerce accounting.
Because these mechanisms, the delayed refunds, the 120-day reserves, they create a scenario where a single sale essentially exists on two completely different timelines.
Yeah, time is the dimension that ruins most e-commerce bookkeeping. You are basically operating on two competing clocks.
Two clocks.
You have the order date and you have the payout date.
Let's walk through the example provided in the source material from A2X, because this really clarified it for me.
Go for it.
So a customer buys a product on June 5th. The software records the order date as June 5th. But because of processing times, batching, and weekends, that cash doesn't actually bundle into a payout and hit your checking account until June 10th.
Right. And that 5-day gap seems harmless until you hit a month end.
Oh, right.
Imagine an order placed on June 29th. The payout hits the bank on July 3rd. Depending entirely on the structural foundation of your accounting, that exact same customer purchase belongs to 2 different months.
And this is the dividing line between cash and accrual accounting, right?
Precisely. The cash method records income on the timeline of the bank account.
Okay.
So you report the revenue when the deposit actually clears on July 3rd.
Got it.
The accrual method, on the other hand, records income on the timeline of the dashboard. You report the revenue when the customer clicked buy on June 29th, completely regardless of when the cash arrives.
See, I always assumed small businesses just picked whichever method felt easier.
A lot of people assume that.
But the guide details strict parameters around this, specifically looking at the 2026 IRS thresholds.
No,
You don't always get to choose.
you certainly don't. For U.S. entities, the IRS dictates eligibility for the simpler cash method.
So what are the rules?
Well, for tax years beginning in 2026, A business generally meets the gross receipts test for cash eligibility if its average annual gross receipts for the 3 prior years do not exceed $32 million.
Wow, okay. That 3-year average is a critical detail. You can't just bounce back and forth between cash and accrual whenever it's convenient for your taxes.
No, you cannot. It is a structural commitment.
So if you cross that $32 million threshold, you are legally required to use accrual,
Yes.
which means your bookkeeping mechanisms must be capable of tracking sales on the exact day they happen, completely independent of the bank deposit.
Exactly. And even if you are under the threshold and happily using the cash method, the time delay still breaks the utility of your dashboard.
How so?
Well, the guide highlights a direct quote from Shopify's own documentation that every single merchant should memorize.
Laid on me.
It says, the payout reconciliation report isn't a statement of revenue for accounting purposes.
Oh, wow. That is as blunt as it gets.
Really is.
Shopify itself is explicitly warning you not to use the cash payout amount to measure your actual business revenue.
Exactly.
So if time permanently fractures the sale from the deposit, you are forced into making a structural choice about how the data actually lands in your ledger.
Right.
The guide calls this the fork in the road. There are only 2 ways to post this data, and the path you choose dictates the entire future stability of your accounting software.
Yeah, you have to choose a posting level. The 2 options are order level posting and payout level posting.
Okay, let me make sure I'm understanding this fork in the road correctly. Order level posting means my accounting software is essentially mirroring my Shopify dashboard minute by minute.
That's the idea.
Every single sale, every single refund, every shipping charge gets its own dedicated line item written into the ledger, carrying the exact date of the customer's order. It's perfectly shaped for accrual accounting.
That is the exact mechanism. Order level captures microscopic detail.
Okay, what about payout level?
Payout level posting, on the other hand, condenses the timeline. It takes the entire payout batch, maybe 100 sales, 5 refunds, and all the processing fees, and it melts them down into one single summary journal entry.
Oh, that sounds cleaner.
It is. The date it carries is the day the payout hit your bank. It takes a shape much closer to cash accounting.
I try to imagine order level posting like taking 1,000 individual grains of sand and trying to pour them through a funnel one by one.
That's a good analogy.
It's incredibly precise. You can count every grain, but it takes forever. Payout level is like melting that sand into a single glass marble and just dropping it through the funnel all at once.
Yes, exactly.
But wait, why would anyone willingly choose the grains of sand? Why would you swamp your accounting software with thousands of individual transaction lines if you don't have to?
Well, sometimes the choice isn't yours. It comes down to strict compliance.
Compliance again.
Yeah. If your bookkeeper or a CPA demands to see every individual transaction dated exactly when the economic event occurred to satisfy strict accrual standards, you must use order level posting.
So they need to see every grain.
Right. The ledger needs those individual grains of sand to prove exactly what happened on June 29th versus July 1st.
But the guide warns about a massive mechanical danger to order level syncing. The ledger grows at the speed of your order count.
And that is a huge problem. Accounting software like QuickBooks or Xero is designed to be a financial ledger, right? It's not a high-volume e-commerce database.
Okay, I see where this is going.
If your store processes 5,000 individual sales a month, order level syncing forces 5,000 new transactions into QuickBooks every 30 days.
That sounds like a lot for QuickBooks to handle.
It is. If you do that, the reconciliation screens will begin to physically lag and freeze. You run the risk of hitting the software's API transaction limits.
Yikes.
For high-volume stores or merchants using multiple marketplaces, forcing individual orders into the ledger will essentially cause the accounting software to collapse under the weight of its own data.
Wow. So payout level posting protects the software.
Exactly, because the ledger only grows at the speed of your payout schedule, maybe 30 entries a month instead of 5,000.
Okay, so you sit down with your team, you weigh the risks, and you decide you want the glass marble. You want payout level syncing to protect your software.
Smart move.
You figure the next step is easy, right? Go to the Shopify App Store, type in accounting integration, download an app, and let automation take over.
If only it were that simple.
Seriously, this guide reveals that the App Store is functionally a minefield.
It is incredibly deceptive. Merchants assume these apps are just generic bridges moving data from point A to point B.
That's what I assumed.
But the software tool you choose secretly locks you into one of those 2 posting methods we just discussed.
The app dictates the accounting method. That is just wild.
Take Intuit's official connector for QuickBooks. Mechanically, it forces order-level posting. It writes a payment received transaction for every single individual sale.
Every single one.
Yes. Conversely, third-party apps like A2X or Link My Books force payout-level posting, generating that single summary journal entry per batch.
And the pricing structures reflect this entirely different architecture, right? Like Intuit's connector is free to install. A2X, for example, charges $29 a month just for their entry tier, which only processes up to 200 orders.
Exactly. You are paying for the mechanism that condenses the data. But the cost isn't the only trap.
Oh no, there's more.
Navigating the App Store handles is where merchants really stumble, and the financial damage of making a bad assumption can be significant.
Yeah. I was legitimately stunned reading this section. If a business owner goes to apps.shopify.com/QuickBooks Online, they are not downloading an app made by QuickBooks.
Nope. Based on the source's data in August 2026, the handle QuickBooks Online belongs to a third-party paid app made by a company called Bold.
That is insane.
It charges from $19.99 a month and sits at a 3.2-star rating.
That has to be the most expensive 5 seconds of confusion a business owner could face. You see, the URL perfectly matches the brand name. You click install, and suddenly you are paying $20 a month for a tool you thought was the official free one.
And Intuit's actual official connector, which holds a 4.8-star rating as of August 7, 2026, is hidden under the handle QB connector.
Unbelievable. And what if your business runs on Xero instead of QuickBooks?
Then you are forced to use third-party tools like A2X because Xero entirely withdrew its direct Shopify app.
Completely withdrew it.
Yeah. If you find their legacy listing, it simply directs you to contact Xero support.
So even if you navigate this maze flawlessly, you find the right URL, you pick the right posting level, there is an automation illusion at play here. Business owners think these apps are a set-it-and-forget-it solution.
They really aren't.
But there are crucial accounting mechanisms these tools simply refuse to automate.
Cost of goods sold, or COGS, is the perfect example of where automation hits a wall.
Right.
These software bridges do not magically know what you paid your supplier for your inventory.
Obviously not.
On a platform like A2X, unlocking COGS calculation requires upgrading to their basic plan or higher. Furthermore, any historical COGS from before you install the app won't sync. You must enter that data manually.
And what happens if the data is just messy? Like, what if I have a product in Shopify, but I forgot to assign it a SKU?
Oh, that breaks the ledger mechanics instantly.
Instantly.
Yeah, if a product doesn't have a matching SKU, Intuit's connector just ignores the inventory side of the transaction entirely.
Wait, really?
Yes. It logs the cash coming in, but it won't decrease your inventory asset account. Suddenly, your books show you have more inventory than you actually do, and your balance sheet is fundamentally unbalanced.
So you still have to actively manage and babysit this software.
Absolutely.
Which brings us to the golden rule of using any connector app. Intuit states this incredibly bluntly in their documentation. When you are looking at your bank feed inside QuickBooks, you must close the transaction by clicking Match. You must never click Add.
This is so important. If we look at the mechanics of the bank feed screen, it pulls a list of deposits directly from Chase or Bank of America.
Right.
Meanwhile, your automation app has already pushed the Shopify sales data into the ledger in the background. If you click Add on the bank feed, you are telling the software that this bank deposit is brand new, unrecorded income.
Oh, no.
You have just duplicated your revenue for the entire month.
You created phantom money.
Exactly. Your only job is to tell the bank feed to match the physical deposit to the data the app already pushed. This entirely dictates the order of operations for setting up your accounting.
Okay, so you can't just wing it.
No, you must never install a tool first and then open the settings menu to figure out what it does.
You have to work backwards from the ledger.
Yes. You must sit down with your bookkeeper before visiting the App Store and answer 3 structural questions.
Which are?
1. Are we required to use cash or accrual accounting based on IRS thresholds? 2. What date should these entries carry to satisfy our reporting? And 3, critically, who is actually going to log in every month and perform that manual match process?
Wow, okay.
You only choose a tool after those answers are locked in.
That makes perfect sense. But let's say a merchant does everything right. They answer the structural questions, they dodge the imposters in the App Store, they buy the perfect app.
The dream scenario.
Right, but the guide points out that there are still edge cases, entire categories of money that flat out refuse to be automated properly.
Gift cards are the prime example, and they require a deep understanding of liability mapping.
Liability mapping. In plain English, that means setting up a holding tank, right?
Basically, yes.
I love the concept that selling a gift card is basically taking a customer's money and holding it hostage. Because mechanically, it's not a sale. You haven't provided a product.
Right. You have taken their cash, but you owe them a jacket. Therefore, the money is a liability.
Makes total sense.
Because of this structural reality, Shopify deliberately hides gift card purchases from your standard sales reports until the moment the customer actually redeems the card for physical goods.
Which is smart because if a merchant forces a gift card purchase into their revenue bucket the moment someone buys it, they are lying to their ledger.
Exactly.
They are paying taxes on income they technically haven't earned yet.
And because Shopify strips them out of the standard sales flow, no automation tool is going to seamlessly handle gift cards without you manually configuring that liability mapping.
So you have to do it yourself.
Yes, you have to explicitly tell the app where the holding tank is. Another major edge case that breaks automation is multi-currency.
I can imagine the math on international conversions gets complicated fast.
It does, specifically because of a rule change on April 6, 2026. Shopify changed how they calculate currency conversion fees.
What changed?
The fee is now calculated on the gross order amount before any other deductions occur.
Oh, wow. Let's break down that math. What are the current rates?
The conversion fee remains 1.5% for merchants in the U.S. and 2% in France and several other regions.
Okay, that doesn't sound too crazy.
But here is the kicker. If you activate the PayPal wallet option for Shopify payments in the U.S. or France, the currency conversion fee jumps to a massive 3%.
Wait, 3%. So if a customer in London buys a €100 item from my US store, that 3% fee is calculated on the full €100, not on whatever net payout is left over after the credit card networks take their cut.
That is correct.
How do the connector apps handle that specific deduction math?
We don't actually know.
You're kidding.
No, I'm serious. The guide points out that as of August 6th, 2026, the official documentation for Intuit's connector is completely silent on how it handles multi-currency.
Silent.
Yeah, it isn't listed as a supported feature, nor is it listed as a limitation.
So if you sell internationally, your ledger might just log a mysterious loss on every international order, and you are left flying completely blind.
Which leads to a surprisingly simple conclusion for some businesses. Buying an app might be a complete waste of your money.
Wait, after breaking down all these automation tools, the ultimate advice for some merchants is to just stay manual.
I mean, software vendors are never going to tell you when not to use their product. But if your business is straightforward one currency, a single sales channel, and your month currently reconciles without you pulling your hair out, you should probably skip the apps entirely.
Because you can just use the reports Shopify is already generating in the background.
Yes, exactly. You can manually stitch together 4 specific Shopify reports: the orders CSV, the payout transaction CSV, the total sales breakdown, and the payout reconciliation PDF. By looking at those 4 documents, a bookkeeper can make one clean manual journal entry per accounting period.
Just one entry.
Yeah. The true test of whether you need to spend money on an API connector isn't your gross revenue, it's the structural complexity of your money.
That is a great rule of thumb.
If you are dealing with multiple foreign currencies, constant chargebacks across borders, or massive volumes of gift cards, you need the app. If you don't have that complexity, save your money and protect your ledger from bad data.
This has been such a journey into the actual plumbing of e-commerce. To recap everything we've pulled from this August 2026 guide. First, stop chasing a single missing percentage in your bank feed. Your sales and deposits won't match because of card fees, delayed refund deductions, and risk assessment reserves.
Spot on.
Second, you have to understand the 2 accounting clocks, the order date versus the payout date, and how the IRS $32 million gross receipts test dictates which clock you are legally required to use.
Also crucial.
Third, choose your post level with your bookkeeper before you ever download an app. Fourth, navigate the App Store minefield carefully, verifying the developer handle to avoid imposters. And finally, when you are reconciling your bank feed, always click Match, never Add.
It ultimately comes down to being deeply deliberate about how you allow data to enter your financial ecosystem.
Absolutely.
Which brings me to a final scenario for you to mull over, building on the structural dangers of order-level posting we talked about earlier.
Okay, let's hear it.
Consider this. If your marketing suddenly goes incredibly viral, and you process 10,000 orders in a single weekend, and you had previously chosen order-level syncing because it seemed easier, Does your accounting software freeze and crash under the weight of your own success?
Oh man, that is a terrifying operational thought. A viral TikTok video could literally brick your QuickBooks account.
Sometimes the biggest threat to your business ledger isn't missing money at all. It is an abundance of raw data that you blindly ask the system to memorize without understanding the mechanical consequences.
What a profound way to look at the architecture of a business. Thank you for joining us on this deep dive. The next time you log into your dashboard and see $10,000 in sales, but only $9,200 in the checking account, you won't panic.
You'll know exactly where it went.
Exactly. You'll know which mechanisms deducted those funds. So, take a hard look at your own dashboard and bank feed today and make sure your ledger is telling the true mechanical story of your business. Until next time.